Hi, it's Erkan here from B Collaboration with Naresh Haldipur from Allans the Accountants, and our latest subject is a really interesting one. This distinction between financial performance and financial strength.
Yeah.
Obviously, if you're running a company out there, you're wondering how can I improve my credit rating? How can I make my business more viable for what may come as opportunity? You know, so you're distinguishing some of the things that we really need to think about.
Yeah.
Have I distinguished it well between the two?
Yeah. I mean, I think it's a question that we get asked a lot. Is how do I improve my credit rating, even though it seems to me that we've made lots of profits? You know, so there's a certain thing there. It's like saying, well, I earn a lot of money, but I can't get a credit card. You know, and that can happen because in order to understand how financial strength is based, you've got to understand what they look for in a company that actually allows you to get a good credit rating.
Yeah, and obviously good credit rating will mean what? I mean,
well, obviously, as you grow, you're looking for means of funding the business, and one of the ways you effectively fund the business is borrow money from your suppliers, which means you have 30-day or 60-day credit terms, so that you don't have to keep borrowing all the money from the bank, which costs money.
Also, better rates on plant equipment. I don't know if you're going to extend your premises or you need to move the place and you need to use cash, lean on cash.
Exactly. And there's one that we often forget about, that credit rating is often looked at by people that do business with you to actually see that you're a stable company. You know, so if you have a very low credit rating, people might see you and say, well, should we do business with them if you know, if the markets move?
So managing your financial strength will give you opportunities, it will give you preferential rates, it will probably attract different companies in terms of doing business with, all sorts like that. So fantastic. So you've in this piece you've also introduced this term EBITDA.
Yeah.
EBITA, and it's one that I've heard many times. I kind of had a notion what it was, but the actual technical meaning of it is?
Well, as I said, if we talk about financial performance first, performance, when you measure one company's performance from another, you need to have consistency in the way you measure them. And all EBITDA is saying that we'll measure them. EBITDA actually stands for earnings before interest, tax, and appropriations. And it simply says measure the performance based on a certain level of profit, because otherwise if you just said profit, you wouldn't know whether someone's talking after tax, before interest, after dividends.
And it's kind of a benchmark way
it's a
of judging where
exactly, it's a benchmark.
Absolutely. So we've got some clear fundamentals of strengthening one's business rating, credit rating, or strength. I think I'd rather focus on financial strength than credit rating, because credit rating is an outcome of your financial strength. Isn't
Exactly.
It? So one of the things you said is the percentage of cash in the bank against balances and assets. So how is that? How are businesses managing this at the time?
So in total, I've said that there's 5 aspects you need to look at to really understand how to get financial strength. So you get financial performance because you make profit. But that isn't what is translated in what you file with Companies House or with the regulators, which actually out there in the public domain is something called your balance sheet. And your balance sheet would say, look at this document, and based on that, we then measure your financial strength. And one of those factors on the balance sheet, which is clearly shown, is your proportion of cash in comparison to all the other assets of the business, which are your debtors, your stock, your prepayments, whatever the case may be.
But there's one real distinction there. You said is as of the date of your financial year end.
Correct.
So all of this can be orchestrated to make yourself look stronger.
Correct.
Or if you're accountant, or you're not. Well, imagine if your accountant is managing these things. It's instructed to. I guess.
Correct. And it can't be done retrospectively, and it needs time to put into effect, even when you're looking forward.
So when would you be looking at? Would you be like for a quarter before your year end? You'd be starting to think about this?
I would actually say, again, you should always be looking at these factors, and then when you're forecasting 12 months ahead, be thinking about, well, these things need to run in line so that when we come to our year end, all of these factors are strong and healthy, so that we report them to Companies House.
So we talk about cash against current assets. We talk about current assets compared to liabilities, which is an easy one. You're out what you're owed and what you owe.
Correct.
That's kind of pretty simple. Net current assets values. How do you determine that?
So a net current asset is simply the difference between your current assets and your current liabilities. and it's a real figure. It's not a ratio or anything. It simply says that if you had net current assets of 5,000, but my net current assets were 500,000, that would make me so much more stable than your company.
You got really big on your one.
Just as an example.
Yeah, it's probably about that because I think you've got loads of money. Right? And then also we talked about these fixed assets, especially property enhanced credit ratings, as opposed to intangibles like goodwill.
Yeah.
So we talk about physical, day in, day out valuables. Who actually does dictate what IP is worth? I mean, that is always a factor in selling a business or buying a business.
You've got it on the nail, because there's a bit of you can't always decide that it's worth a certain value. Because of that, credit rating agencies will say, well, we don't look at IP, or we don't look at goodwill or intangibles with this having the same strength as a normal bricks and mortar commercial property.
And is that the case for small businesses? Because I mean, big corporations, that is a big part of their asset, isn't it?
Correct.
We're looking at, obviously, going from SME, owner-operated type businesses to big corporates. Their IP, their intellectual property, their brand values, how that makes a mark in the market is something that's very much...
It's something that's very popular, yeah. But again, because we're discussing more at the SME end, I think at the SME end, what's relevant is that if you did want to increase your financial stability, you should do so certainly by consideration of, it's not a requirement, but consideration of purchasing commercial property on the company books to give it that strength.
Brilliant. Now, if I'm sitting here and I'm watching this video, I mean, what are one or two things that I should really focus on? I mean, obviously you've laid out a few, but what are the kind of key things you're advising clients to really manage well?
Well, I think ultimately cash is king, always the case. So leading up to the reporting date, which is the date that you'll be publishing accounts, make sure that your cash reserves as a proportion to your total assets are kept as high as possible. And it just needs to be at that point in time, because when you do a disclosure to Companies House, it's based on your disclosure. Let's say your year end is the 31st March. It's based on the position as at the 31st March. What you then do on the 1st of April is up to you.
So you could build up a whole load of cash and then plan ahead.
Exactly.
So there is some real So I suppose this is where having a good FD or FD skills within your, or access to good FD skills is planning ahead 18 months a year in advance.
It's all
where
about
you
planning.
Want to be. Yeah, absolutely.
Yeah. Fantastic.
So good. So basically, cash is king. Plan ahead.
Yeah, definitely.
And on that note, thank you very much.
Thank you.